Good afternoon, everyone. Today's video we will tackle about types of firm. And let's proceed. Types of firm. A firm's business activities are typically conducted under the firm's name, but the degree of legal protection for employees or owners depends on the type of ownership structure under which the was created. Some organization types, such as corporation, provide more legal concept of the nature firm that has been firmly established. Firms can assume many different types based on their ownership structures. First, solely proprietorship, solely trader is owned by one person who is liable for all costs and obligation and own all assets, although not common under the firm umbrella. There exist some obsolete proprietorship businesses that operate as firms. 2. A partnership is a business owned by two or more people. There is no limit to the number of partners that can have a stake in ownership. A partnership's owners each are liable for all business obligations, and together they own everything that belongs to the business. 3. In a cooperation that businesses' financials are separate from the owner's financials owners of a corporation are not liable for any cost, lawsuits, or other obligations the business. A corporation may be owned by individuals or by a government, though business entitles corporations can function similarly individuals. For example, they may take out loans, enter into contract agreements, and pay tax. A firm that is owned by multiple people is often called a company. 4. A financial cooperative is similar to cooperation in that its owners have limited liability with a different that is investors have a say in the company's cooperation. And this is the end of the types of firms discussion. Thank you. Supply function is a numerical portrayal of the association between the amount expected quantity demand of a product or service, its value, and other related factors. For examples, related product, cost, and input cost. A supply function has numerous individual dependent variables and independent variables. The supply function can be written in the form of an equation. Qs equals C plus dP, where Qs is quantity supplied. C stands for the level of supply independent. For price, P the market price of the product. Let's talk about law of supply. The law of supply is the microeconomics law that states that all other factors being equal, as the price of a good or service increases, the quantity of the goods or service that suppliers offer will increase and vice versa. In other words, when price paid by buyers for a good rises, then supplier increase the supply of the good in the market. Producer surplus, industry supply. Producer surplus is the difference between how much a person would be willing to be accept for a given quantity of a good versus how much the market price. The difference or surplus amount is the benefit that the producer receives for selling the good in the market. Industry equilibrium in the short and long run. In the long run, a firm just earns profits. If a firm earns supernormal profits in the short run, then the industry will attract new firms into it. Eventually, this leads to a fall in price of the goods and an increase in price of the factors as the industry expands. Zero economic profit is a condition in which a firm's total revenue is equal to the sum of its explicit and implicit cost. In other words, it occurs when the revenue of a firm minus its explicit cost minus implicit cost is equal to zero. Rental rates and price. Rent is an amount of money carried that exists that which is economically or socially necessary. This can occur, for example, when a buyer working to attend a good or service that is considered exclusive makes and often prior to having what a seller considers an acceptable price. Define a income derived from ownership or control over a limited assets or resource. Such income is attained without any expenditure or export on behalf of the resource holder or in excess of their opportunity cost.